Welcome to the quarterly earnings conference call. All lines have been placed in listen-only mode until the question-and-answer session. Today's call is being recorded. If anyone has any objections, you may disconnect at this time. I would now like to turn the call over to Mr. Rich Kinder, Executive Chairman of Kinder Morgan. Sir, you may begin.
Okay, thank you, Kim. And before we begin, as usual, I'd like to remind you that today's earnings releases by KMI and KML and this call include forward-looking and financial outlook statements within the meaning of the Private Securities Litigation Reform Act of 1995, the Securities and Exchange Act of 1934, and applicable Canadian provincial and territorial securities laws, as well as certain non-GAAP financial measures. Before making any investment decisions, we strongly encourage you to read our full disclosures on forward-looking and financial outlook statements and use of non-GAAP financial measurements set forth at the end of KMI's and KML's earnings releases, and to review our latest filings with the SEC and Canadian provincial and territorial securities commissions for a list of important material assumptions, expectations, and risk factors that may cause actual results to differ materially from those anticipated and described in such forward-looking and financial outlook statements. Before turning the call over to Steve and the team, let me make a few quick remarks. As you can see from our excellent 2018 results and our 2019 budget overview already released, the assets at KMI are generating strong and growing cash flow. This is obviously a very good thing, but the question is how to deploy that cash in the most effective way to benefit our shareholders. On that question, we get lots of suggestions from analysts and investors. As we have said so frequently, we can use the cash for four different purposes: to pay it out as dividends, to buy back shares, to pay down debt, and to reinvest in capital projects. Over the past 3 years, we have used our cash for all of those purposes in varying degrees. We have paid off over $8 billion of debt and reduced our debt-to-EBITDA ratio to our targeted 4.5 level, and have had our credit rating upgraded by both S&P and Moody's. We've raised the dividend from 50 cents in 2017 to 80 cents in 2018, and reiterated our intention to increase it to $1 in 2019 and to $1.25 in 2020. We've bought back over $500 million worth of shares, and we have funded our growth capital without needing to access external sources. Now, in my view, that's a pretty positive story. You can quibble about how the money gets allocated, but I believe investors should appreciate the overall flexibility that this strong cash flow provides. And we will continue to use our cash flow in a disciplined way that most benefits our shareholders. As we have said so many times, the management and board of KMI are significant shareholders, and our interests are pari passu with the rest of the shareholder base. Steve?
Yeah, thanks, Rich. As usual, we'll be updating you on both KMI and KML. I'm going to start with a high-level overview and then turn over to our President, Kim Dang, to give you an update on our segment performance. David Michaels, KMI CFO, will take you through the numbers. Then Dax Sanders will update you on KML, and we'll take your questions on both companies. The fourth quarter capped a transformative year for KMI as we grew our business, strengthened our balance sheet, increased our dividend, and continued to find attractive new opportunities to expand our network. We experienced outstanding performance in our natural gas segment, our largest segment, where we saw significant year-over-year growth. We brought expansion projects online and added new project opportunities to the backlog, highlighted by our Permian Express pipeline project, which we FID'd earlier in the year, and which brings an additional 2 BCF a day from the Permian Basin to our extensive intrastate pipeline network on the U.S. Gulf Coast. That project, like our Gulf Coast Express project, is secured by long-term contracts. We experienced a record increase in natural gas supply and demand across the country, and 2019 is projected to be another solid year of growth for U.S. natural gas. That growth drives the value of our existing network and creates opportunities for us to invest capital at attractive returns to expand that network. We had solid contributions from other parts of our business as well, and Kim and David will take you through our results. We made tremendous progress during 2018 in strengthening our balance sheet. We self-funded our expansion capital expenditures, as we have since the latter part of 2015. We also sold our Trans Mountain pipeline and the Trans Mountain expansion project for $4.5 billion Canadian. That transaction allowed us to return substantial value to our KML and KMI shareholders while enabling the strengthening of our balance sheet and the de-risking of both entities. In large measure, as a result of that transaction, we were able to end the year with our debt-to-EBITDA multiple at 4.5 times, handily beating our goal of 5.1 times, which is what was assumed in the 2018 plan. So we had a very good 2018, and as we showed in our 2019 guidance release, we're expecting good year-over-year growth in 2019 as well. Now we will be focused on our 2018 results in today's call. The timing of this call, as always, comes right before we do our Investor Day. We'll have that next week, and we'll go into the details on 2019 at that time. With that, I'll turn it over to Kim.
Okay, thanks, Steve. Well, natural gas had another outstanding quarter. It was up 8%. Market fundamentals there remain very strong. For the full year, natural gas demand increased from approximately 81 BCF a day to approximately 90 BCF a day, a 9 BCF a day, or 11% increase. This is driving nice results on our large diameter pipes. For the fourth quarter, transport volumes increased approximately 4.5 BCF a day on our transmission system, a 15% growth. Deliveries to LNG facilities were over a BCF in the quarter. That's approximately a 400 million cubic feet a day increase versus the fourth quarter of 2017. Power demand on our system for the quarter was up 300 million cubic feet a day, and exports to Mexico on Kinder Morgan pipelines were up a little over 70 million cubic feet per day. Overall, as Steve said, this higher utilization of our system, a lot of which came without the need to spend capital, resulted in nice bottom line growth in the quarter, and longer term will drive expansion opportunities. On the supply side, we're also seeing nice volume growth. On our gas and crude gathering systems, volumes were up 21% and 13% respectively, driven by higher production in the Haynesville, the Bakken, and the Eagle Ford. In the Haynesville, our volumes more than doubled in the quarter and now are just slightly over a BCF per day. A few updates on the large projects. On PHP, we have identified an opportunity to increase the capacity by about 100 million cubic feet a day and are currently working to sell that capacity. On GCX, we've secured 100% of the right-of-way. Construction is underway, and we remain on target for an October 2019 in service. On our Elba liquefaction project, we currently anticipate that we will be in service at the end of the first quarter. This has continued to be a delay, but fortunately, we do not expect the delays to have a material impact on our costs, given the way our construction and commercial contracts are structured. In our product segment, we benefited from increased contributions from Cochin, Utopia, and Double H, offset somewhat by lower contributions from KMCC due to lower contract rates on that pipe. Refined volumes were up 1%, which is consistent with the EIA. Crude and condensate volumes were up 10%, and that's due to increased volumes on our pipelines in the Eagle Ford. However, there in the Eagle Ford, as I said, on KMCC, the impact of those incremental volumes was more than offset by the lower pricing. And higher volumes in the Bakken, where volumes were up 38%. NGL volumes were down 11% due to unattractive product differentials. However, the lower volumes here have minimal financial impact given the nature of our contracts. Our terminals business was down 5% in the quarter. The primary driver is a lease payment from Edmonton South to Trans Mountain that prior to the sale of Trans Mountain was eliminated as an intercompany transaction. Excluding the lease payment, the terminal segment would have been down less than 2%. Our liquids business, which accounts for approximately 80% of the segment, was essentially flat, with expansions in Houston and Alberta offsetting weakness in the Northeast. Our bulk business was down due to certain asset divestitures and lower contributions from coal, primarily due to a customer contract expiration, and that's despite higher coal volumes. Our bulk tonnage was up 10% in the quarter, with the largest driver being coal volumes. Coal volumes were up almost 1 million tons. Our liquids utilization was essentially flat in the quarter. CO2 segment benefited from higher CO2 prices, but that benefit was offset by lower average crude oil price and lower NGL volume. Net crude oil production was flat versus the fourth quarter of 2017, with increased volumes at SACROC largely offset by reduced volumes at our smaller fields. SACROC volumes were up 5% versus last year. They were 8% above our plan as we continue to find ways to access the significant remaining oil in place in that field. Tall cotton volumes were up 26% versus last year, but below budget. And NGL volumes were down 7% in the quarter due to a plant outage, but that has since been remedied. Our net realized crude oil price was down 6% in the quarter, and that's despite a higher WTI price. The WTI hedges we have in place, as well as the increase in the Mid-Cush differential offset the increase in the WTI price. For 2019, as we've told you previously, we've substantially hedged the Mid-Cush differential. And that's the update on the segments, and with that, I'll turn it over to David Michaels.
Thanks, Kim. Today, we're declaring a dividend of 20 cents per share, which rounds out our 80 cents per share dividend declared for the full year 2018. That's consistent with our 2018 budget and the plan that we announced to shareholders in July 2017. It also represents a 60% increase over the 50 cents per share we declared for 2017. We also generated distributable cash flow of 2.65 times our declared dividend for the year. KMI had a very good quarter to cap off a very strong year. We grew meaningfully from last year's fourth quarter and ended the full year nicely above plan and nicely above 2017. In addition, as Steve mentioned, we significantly strengthened our balance sheet during the full year, and that strengthening helped result in recent credit rating upgrades by both Moody's and S&P to mid-BBB each, as Rich mentioned. On earnings, our revenues were up $149 million, or 4% from the fourth quarter 2017, and operating costs were down $101 million, or 18%. However, there were some certain items both this quarter and in the fourth quarter 2017 that create a little comparability noise. As a reminder, we define certain items as items that are recorded under GAAP but are non-cash or occur sporadically, and which we believe are not representative of our business's ongoing cash-generating capability. So excluding certain items, operating income would be up $35 million, or 3% from the fourth quarter of 2017. Net income available to common stockholders for the quarter was $483 million, or 21 cents per share, which is an increase of $1,528 million and 68 cents per share versus the fourth quarter of 2017, a 146% increase. This very large change was driven by a reduction in our deferred tax asset taken as a certain item during the fourth quarter of 2017 as a result of the federal tax rate cut. That's a good example of a certain item that can make it difficult to compare our business's operating performance period over period. Looking at earnings adjusted for all certain items, this quarter we generated $565 million of adjusted earnings versus $469 million in the fourth quarter of last year. That's a $96 million improvement, or 20% better quarter over quarter. Adjusted earnings per share is 25 cents, which is 4 cents, or 19% higher than the fourth quarter of 2017. Moving on to distributable cash flow. DCF per share is 56 cents for the quarter, up 3 cents or 6% from the fourth quarter of 2017. The natural gas segment was the largest driver of that growth. The natural gas segment was up $83 million, or 8%, and that segment benefited on multiple fronts, as Kim mentioned. EPNG and NGPL were both up, driven primarily by Permian supply growth. Kinderhawk and South Texas assets were up, driven by increased volumes from Haynesville and Eagle Ford. CIG was also up due to growing DJ Basin production. Those are partially offset by lower commodity prices impacting our Highland assets and lower contribution from GLNG due to an arbitration ruling calling for a contract termination. Product segment was up $3 million. Terminals were down $15 million, and CO2 is down $12 million. Kim covered the main drivers behind the changes in those segments. KMC was down, Kinder Morgan Canada was down $50 million for 100%. That's due to the Trans Mountain sale, which closed in August. D&A, our general administrative expenses, were lower by $66 million, driven by a greater amount of overhead capitalized due to a greater amount of spending on growth projects. Non-recurring expenses we incurred during the fourth quarter of 2017, and lower G&A from the sale of Trans Mountain. Interest expense is $6 million higher, driven by higher short-term interest rates, which more than offset benefit we received from having a lower debt balance, as well as interest income earned on the Trans Mountain sale proceeds. Preferred stock dividends were down in the quarter due to the conversion of our mandatory convertible securities occurred in October. Cash taxes were lower by $1 million, driven by higher state tax refunds. Sustaining capital was $9 million higher versus 2017. Our natural gas product segment partially offset by lower sustaining capital for the sale of Trans Mountain. That was consistent with what we had budgeted. We had budgeted sustaining capital for 2018 to be higher than 2017. We are ending the year relatively close to plan, except for the Trans Mountain sale. Total DCF of $1,273 million is up $83 million, or 7%, driven by greater contributions from natural gas, lower G&A expenses, and lower preferred stock dividends, partially offset by the sale of Trans Mountain and higher sustaining CapEx. DCF per share is up 56 cents per share, up 3 cents or 6%. Same drivers as DCF, but with the partial impact from the incremental shares from the conversion of our preferred stock. For the full year 2018 versus 2017, DCF was up $248 million, or 6%, and DCF per share was $2.12 per share, or 12 cents and 6% above 2017. So very good full year performance. For the full year relative to budget, DCF of $4,730 million was up $163 million, or 4% from our budget for the year. Our DCF of per share of $2.12 is up 7 cents from our budget of $2.05, or 3% higher. So very nice performance for the full year versus plan as well, especially considering the sale of Trans Mountain and had budgeted all the liquefaction to be in service during 2018. Now turning to the balance sheet, just like last quarter, you're going to see two net debt to EBITDA figures listed. The 4.4 times includes all of the Trans Mountain sale proceeds, as we consolidated all of that cash from KML's balance sheet onto KMI. Including the cash that was paid to KML public shareholders on January 3rd, which is estimated at the end of the year, $890 million, our adjusted net debt to EBITDA was 4.5 times, which is the second number. That 4.5 is a little bit better than last quarter of 4.6, and is much improved from year-end 2017 of 5.1, as well as the 5.1 we had budgeted for the full year of 2018. Obviously, Trans Mountain's sale was the largest driver of that improvement. Proceeds have now been distributed to both KMI and to the public KML holders. We used a portion of our share to pay down a little more than $400 million that we had on our revolver, and we used most of the remainder to fund a $1.3 billion bond maturity that's coming up here in February. Two largest changes on the balance sheet to note here are from year-end are cash and PP&E, and both of those are largely driven by the Trans Mountain sale. Net debt ended the quarter at $34.2 billion, which is a decrease of $2.5 billion from year-end and a decrease of $400 million from last quarter. So I'll reconcile those here briefly. Quarter change, we had $1.27 billion in DCF. We spent $586 million in growth CapEx, contributions to our joint ventures, and dividends of $455 million. We repurchased $23 million of shares, and we had a working capital source of $184 million, which largely driven by a tax refund received for approximately $400 million reduction for the quarter. For the full year, the $2.5 billion lower debt, driven by $4.7 billion of our DCF, growth CapEx and JV contributions of $2.57 billion, $1.6 billion of dividends, $273 million of share repurchases, the divestiture proceeds, mostly because of Trans Mountain, $3.4 billion. Less the KML public shareholders portion of those proceeds, $890 million. And then we had a working capital use of $300 million, which was largely driven by our rate refund payment during the year. That reconciled to $2.5 billion lower debt. And with that, I'll turn it back to Steve.
Okay, now we're going to turn to KML, and Dak Sanders will give you the update.
Thanks, Steve. Before I get into the results, I do want to update you on a few general items. First, as the release mentioned, we made the promised return of capital distribution associated with the Trans Mountain sale on January 3rd. More specifically, we distributed almost $1.2 billion to KML's restricted voting shareholders for approximately $11.40 a share. We also completed a 3-for-1 reverse stock split that was approved at the shareholders meeting last November. With respect to the sale of Trans Mountain, you will recall that the agreement calls for a customary final working capital adjustment. We are substantially through that process and the review of the calculation with the Government of Canada and believe that the final adjustment will result in us making a final cash payment back to the government of approximately $35 million in the first quarter. And as such, we have booked this amount. This adjustment should not be viewed as a lowering of the purchase price or an otherwise change to the economics of the deal. Rather, it simply reflects that at closing we delivered less cash to the government than was contemplated. Consequently, and as I will walk you through in a minute, this will not have an impact on the previously communicated net cash and net debt position of KML. Moving to the business front, this is the first quarter where Baseline was essentially in service for the entire quarter, and it contributed nicely to the portfolio. As of the end of the year, we had spent approximately $348 million of our share, with just over $8 million remaining of the total project spend to our share of $357 million. The $357 million compares to the original estimate of $398 million, and as I had mentioned previously, it is a result of cost savings on the project. Finally, a topic that I know is on everybody's mind is KML's ongoing strategic review. While we don't have anything to announce as the review is ongoing, we are hopeful that we will have the review completed in a direction to announce by the next earnings call. While this review is taking some time, the time we are taking is necessary given the range of options, the cross-border complexity, the fact that a strategic combination or sale of the company are among the options, and the evaluation of those options require third-party price and term discovery, and that process takes time. Now moving towards the results. And of note, as I talk through the results, I'm generally only going to reference results of continuing operations, as we believe those are much more useful and relevant. Today, the KML board declared a dividend for the fourth quarter of .1625 per split adjusted restricted voting share, or 65 cents annualized, which is consistent with previous guidance. Earnings per restricted voting share from continuing operations for the fourth quarter of 2018 are 30 cents, and that is derived from approximately $40 million of income from continuing operations, which is up approximately $22 million versus the same quarter in 2017. The biggest contributors to the increase are strong revenue associated with the Baseline tank and terminal coming online, and interest income associated with the proceeds from the Trans Mountain sale. I do want to offer one comment on the almost $28 million loss on discontinued ops. That is due almost entirely to the $35 million payment on Trans Mountain that I mentioned. Adjusted earnings from continuing operations, which exclude certain items, were approximately $43 million compared to approximately $18 million for the same quarter in 2017. Total DCF from continuing operations for the quarter is $62.9 million, which is up 28.7 from the comparable period in 2017. That provides coverage of approximately $13 million and reflects a DCF payout ratio of approximately 31%, which is obviously somewhat skewed from the interest income. Looking at the components of the DCF variance, segment EBITDA before certain items is up $9.9 million compared to Q4 17, with the pipeline segment up approximately $6.1 million and the terminal segment up approximately $3.8. The pipeline segment was higher primarily due to the recognition of deficiency revenue on Cochin and the non-recurrence of an inline inspection done in Q4 2017. The terminal segment was higher due primarily to Baseline coming online, as the asset was not in service in 2017, and higher contract renewal rates at the North 40, partially offset by the expiration of a contract on the Imperial JV and the one-time nature of a capital true-up via the same asset in 2017. D&A is essentially flat. Interest is favorable by approximately $24.7 million due to the interest on the Trans Mountain proceeds and lower interest expense. The cash tax line item was essentially flat. Preferred dividends are up $2.6 million, given Q4 2018 had both tranches outstanding for the full quarter of tranches of the preps. Sustaining capital was unfavorable, approximately $3.6 compared to Q4 17 due to timing on some work on both Cochin and within the terminal segment. Looking forward to 2019, as with last year, I'll walk you through the details of KML's budget at the analyst conference next week. With that, I'll move on to the balance sheet comparing year-end 2017 to 12/31/18, and my comments will focus only on the line items related to the retained assets and not the assets or liabilities held for sale. Cash increased approximately $4.227 billion to $4.338 billion. As I mentioned last quarter, there's a lot of moving pieces in the change associated with Trans Mountain that stem from the CapEx spend on behalf of the government credit facility, and other purchase price adjustments, such that I'm not going to take you through all that on this call, but if you want more detail, feel free to give us a call. Generally, the increase is the proceeds received from Trans Mountain plus DCF generated, less expansion capital, less distributions paid net of the DRIP, and less the payoff of the debt we had when we received the sale proceeds. More importantly, let me take you through the pro forma reconciliation of what that year-end cash balance looks like, taking into account the immediate uses of the Trans Mountain proceeds following year-end. Starting with the $4.338 billion in cash, approximately $3.977 billion was paid out with the special distribution on January 3rd. That's the sum of the $1.195 distribution payable to restricted voting shareholders and the $2.782 billion distribution payable to KMI, both shown on the balance sheet. Next, approximately $308 million of cash taxes from the gain on the sale will be paid in Q1. Finally, you deduct the $35 million final adjustment back to Canada that I mentioned. Netting all those items leaves you with a net cash position, obviously with no debt, of approximately $18 million. This is consistent with the comments we have previously made about KMI having little or no net debt after taking into account all the moving pieces associated with the Trans Mountain sale and associated distributions. Other current assets increased approximately $2 million due to an increase in AR associated with Baseline coming online, transition services agreement billing to Trans Mountain, and interest receivable from interest on the Trans Mountain proceeds. Net PP&E decreased by $7 million as a result of depreciation in excess of net assets placed in service. Deferred charges and other assets have decreased approximately $63 million, which is a result of the write-off of the unamortized debt issuance costs associated with the Trans Mountain facility that we canceled. Moving on to the right-hand side of the balance sheet, as I mentioned, distributions payable and distributions payable to related parties increased from 0 to 1.2 and 2.8 billion respectively, as we've reflected the special distribution. Other current liabilities increased $337 million, primarily due to taxes payable on the Trans Mountain sale. Other long-term liabilities decreased by $283 million, primarily as a result of the deferred tax liability released as a result of the gain of the Trans Mountain sale. And with that, I'll turn it back to Steve.
Okay, thanks, Dax. We want to take a moment to honor our late General Counsel, Kurt Moffitt, who passed away on December 28th while skiing with his family. In addition to being a fine lawyer, Kurt was a fine human being who formed deep personal connections with the people he worked with. We lost a trusted colleague, but many at Kinder Morgan also lost a friend and a mentor. Kurt loved his work, and his heart shone through in it. We'll miss him. Okay, with that, Kim, if you'll come back on, we'll take questions. Like we did last time, as a courtesy to everyone who has questions, we ask that you ask one question, that you hold yourself to one question and one follow-up, and if you have more questions, we'll get to them. You just get back in the queue, and we'll take you up in due course, okay? Thank you.
Thank you. At this time, if you'd like to ask a question, please press *1, and please record your name when prompted. If you'd like to withdraw your question, you may press *2. Again, to ask a question, please press *1. One moment, please, while we take the first question. And our first question comes from Jeremy Tonis with J.P. Morgan.
Hey, Jeremy.
Good afternoon. Thanks. Just want to start off here on the CO2 segment, and taking into account some of the volatility we've seen in commodity prices here. I was just wondering how much of the $5.7 billion in the capital in the backlog relates to the CO2 segment, and does the commodity price environment kind of impact, I guess, the pace or how you think about that spend given this volatility?
Yeah, so in the CO2 segment, we've got about $1.6 billion backlog, and we'll go through this in more detail in the conference. And yeah, in CO2 and also in our gathering and processing business, we look at CapEx on an ongoing basis. So we take into account commodity prices and obviously the break-even economics with the return. for the projects that we look at. So we typically will have ins and outs in both of those segments, and obviously if commodity prices are lower, they tend to be outs. The main topic there is tall cotton, and we will continue to evaluate tall cotton and whether we make substantial additional investments in there as the year goes on.
That's helpful, thanks. And just wanted to touch on SG&A, and it just being down kind of 40%, $67 million here year over year, it seems like a big kind of step down, and it seems like some of that's related to growth CapEx and capitalization there. But just wondering if you could provide a little bit more color on that, and is this kind of a new run rate, or is the run rate something lower? Any more color you could provide would be helpful. Thanks.
That's right. A good bit of it does relate to capitalization. David, do you want to go through the?
About half of it is capitalization, and we had greater burdenable capital spend in the year of about $300 million relative to the prior year. So you put a reasonable capitalization rate on that, and we get to around $30 million of greater capitalized G&A costs. So a lot of that was driven by GCX, which is a pretty major project, Elba liquefaction spend, and so we had a couple of major projects that we were spending there, as well as all of our ongoing projects as well. And then a big chunk of that also was one-time G&A costs that we had in 2017 as a result of an internal policy change, which allowed more paid time off to be carried over to the subsequent year. And then, of course, we had lower G&A costs in 2018 as a result of Trans Mountain being sold.
So 130 is kind of more of a real run rate G&A going forward, the way to think about it?
Well, depending on the level of the capital spend, we'll have to evaluate that going forward.
And we'll show you our G&A budget for 2019 at the conference next week.
Gotcha. And just my first question, just confirm real quick, 1.6 CO2 is of that 5.7. That's the right way to think about that for the backlog?
Almost all of the remainder is in natural gas.
That's very helpful. Thank you.
I think our next question comes from Colton Bean with Tudor, Pickering, Holt & Co.
Good afternoon.
Afternoon. So you mentioned the improved results there in the Permian network. Is that primarily a result of throughput, or are you still seeing some further increases in negotiated rates? I guess just as a follow-on to that, when you bring GCX into service later this year, is there any potential for rate improvement on maybe the Tejas network there in South Texas?
Yeah, so I guess first part of the question, yes, it is improvement in ultimately the rates that come up for renewal. And I think on the second part, just as more gas comes into the state of Texas, dispersing that across our network, both for domestic consumption and export demand, I think there are some opportunities to increase rates on any contracts that have renewal opportunities.
Got it. And I guess just on the proposed joint venture with Enbridge and oil tanking for the coal terminal, any thoughts as to how that project integrates with the existing footprint and whether there might be some ancillary opportunities if you were to reach FID there?
Yeah, so initially there's not integration the initial size that we would expect. And again, this is not in our backlog. This is something that we're working on with our partners and we're in development on. And before we would put it in our backlog, we would need to see substantial commitments from shippers. In the early part of the project, the first build, we wouldn't expect to necessarily see it, but we could add connectivity in larger builds to KMCC.
That's helpful. Thank you.
I think our next question comes from Danilo Giovanni with BMO Capital Markets.
Good afternoon.
Thanks, and good afternoon. My first question is on BHP. With a little uptick in capacity, the $100 million, I was under the impression that you already capped out in terms of MAOP. What were you able to do to get this incremental $100 million squeezed out, and can you do the same thing with GCX?
Well, when we ordered compression, we upsized the compression order. So it was a long lead time item, and we thought there's there's market for it if we can squeeze some more out, and so we ordered a larger compression equipment, large capacity compression equipment. And GCX will look for little pockets here and there, but I would say, Tom, largely tapped out there.
Yeah, I think that's a fair assessment.
Got it. And my second question is sticking on the pipes. Obviously, with what's happening with PG&E in California, Ruby has come up with respect to it having, I think, $375 million of contracts. How should we think about that as the potential for bankruptcy unfolds there? Are those contracts tied to assets that are base load and must run? How are you guys thinking about that process for Ruby?
Yeah. Look, I think there's some. There's always uncertainty in a bankruptcy proceeding, but I think there's some cause for optimism. Let me first, around the Ruby contracts in particular, let me first start out by pointing out that it is Ruby specifically and exclusively that would be impacted by the potential PG&E bankruptcy, so it's those two contracts. One of those contracts serves the electric generators that PG&E uses to obviously generate power and serve its load. The other provides service to PG&E's gas distribution business. So we view both of those as core contracts that are core to PG&E's business. Those two contracts together represent about $93 million a year of demand revenue. So it is a material matter to our interest in Ruby. Again, while the bankruptcy process is uncertain, there's important facts. One is what I said, that they serve PG&E's core business. These contracts are used by PG&E, and we've been told to expect continued utilization of those contracts. These contracts help PG&E in meeting its service obligation to core customers. The contracts were approved by the CPUC when they're entered into. The CPUC does require PG&E to maintain upstream firm transport capacity. And so those reliability aspects, we think, help improve the chances of affirmation. Again, the process is uncertain. And I'd also say those reliability aspects were confirmed recently with the GTN outage and diminished capacity there, which caused an increase in takes on the Ruby contracts. So even though the current basis is lower and below the long-term contract rate, there are reliability benefits to be considered. And finally, it's our understanding, at least, that in PG&E's prior bankruptcy proceeding, they did not reject firm transport contracts. So that's not proof of what they'll do this time, but we think there are reasons for optimism on these contracts.
Thanks for the clarification. I'll get back in the queue.
Thank you. The next question comes from Ciro Dunas with Credit Suisse.
Hey, good afternoon, everyone. I just want to start off with 2019 CapEx guidance. Looks like cash flows should fund the majority of that and dividends, but it looks like I think I back into a number of about a $400 million hole to make up somewhere else. Should the remaining CapEx, should the assumption be that basically funded with debt at this point, or could we see some non-core asset sales there?
Yeah, those are not really linked. We would look at those individually, but there could, at these numbers, there would be an expectation of some small debt financing. So we would be financing more than all of the equity requirement and a substantial portion of the debt requirement for those capital investments. And we'll take you through that in next week's conference.
And there's plenty of availability on the revolver.
Got it. Okay. And then just wanted to touch base again on the Bakken and get your latest thoughts around expanding Double H now that some new projects have been announced. I think there's the 300,000 barrel a day open season on Pony Express. Liberty Pipeline announced a 350,000 barrel open season too. So call it 650,000 needs to get down to Guernsey somehow if both of these go through. Just curious what that means for Double H here.
Yeah, that's something that we're actively looking at. Volumes continue to grow, and we continue to work on solutions for our customers to get them through to Cushing. And there is some expansion capability on Double H.
Okay, appreciate it, Keller. See you guys next week.
think our next question comes from Harry Mateer with Barclays.
Good afternoon, Harry.
Hi, good afternoon. First, just to follow up on Ruby, how should we think about the indemnification agreement that's in place from KMI on 50% of Ruby's debt? And then, just to clarify, Steve, have you been told since the recent bankruptcy headlines that you should continue to expect utilization of those gas supply contracts?
First, the indemnification no longer exists. And second, we're in pretty continuous conversations with our customers.
Okay, thanks for that. And then, David, you mentioned the KMI plans to pay down the February maturities. So I know the analyst day is next week, but can you just give us a sense for how you plan to manage the timing and or magnitude of new debt issuance for the balance of the year? Should we just assume late in 2019, given the $1.5 billion maturity that comes due in December?
We'll provide more information on that during the analyst day, but no near-term needs because of the cash that we have on hand.
Got it. Thank you.
I think our next question comes from Tristan Richardson with SunTrust.
Hey, good afternoon, guys. Just curious on the projects added to the natural gas backlog in 4Q. Could you give us some highlights there of where that is, either geographically or around the chain, whether it be midstream or transmission in general regions?
Yeah, so it's probably half midstream, which part of that is on our intrastate system, other in the GMP side, and then the other half, I would say, is supporting an LNG project yet to come.
Great, thank you. And then just a quick follow-up. You talked about following up on a previous question about the Bakken and the volume growth you saw there. And can you talk about utilization today and whether or not there's further headroom for growth on the existing asset base, or the potential for expansion would require capital?
Yeah, so we are investing in our gathering assets in the Bakken because they are constrained, and so we have investments to expand our takeaway capability there, gas and crude. To get more out of Double H, we would have to expand it. We would have to invest capital in it.
Understood. Thanks, guys, very much.
I think our next question comes from Dennis Cole with Bank of America Merrill Lynch.
Yeah, hi. Good evening, everyone. A couple questions. One, if I could go back first to the KML strategic review. Maybe this is reading a little bit too much into sort of what I'm hearing, but Dax, it seemed like you sort of emphasized that the options you listed were just among the options that are available, and I wonder if you might talk about what you mean by that, or what other options we should be thinking about.
Yeah, thanks, Dennis. I mean, I think the options that are on the table are all the ones that we've articulated before. I mean, KML has a good set of assets that could continue as a going concern. It could be one of the strategic transactions that I talked about. It could come back to KMI. So I think all of the options that there's not anything new that we have previously spoken about, and I think we're going to be very thorough in thinking about every single one of those and which one makes the most sense.
Okay, that's what there's nothing new there that hasn't sort of been vetted out. So.
Right.
Perfect. And then I guess just to dig a little bit deeper on the terminals decline, I understand the Edmonton terminal, but the other thing that's talked about in the release is the New York Harbor issues. I wonder if you might just expand upon that a little bit. And is it a one-time thing? Is it seasonal, or is there some impact on the business that is more permanent?
It's the same issue that we brought up last time at Staten Island. We're roughly 60% utilized there. We've done a great job over the last 2 quarters of kind of getting our head back above water, but we're looking at strategic alternatives for the site at this point. We're hoping that we'll have clarity on that in Q2, and we'll be able to indicate it on the next earnings call.
But the reason that Staten Island is uniquely impacted is because there was a spill tax enacted
13.75 cents on every barrel that goes through there, which renders it uncompetitive with New Jersey terminals. Our own being two of them.
Got it. Okay. Thanks for that. I'll jump back.
Okay, the next question comes from Jean Salisbury with Bernstein.
Hi. Is the government shutdown having any impact on your, interactions with FERC, either the 501G process or on the pipeline permitting and approval side?
No, FERC is funded, and so the answer there is no. I mean, I think there's a separate question about how a deadlocked commission will operate on certain things, but the answer is no. And more broadly, Jean, the government shutdown is not having really much of any impact on us right now. In time, with U.S. Fish and Wildlife not funded, it could have some impact on permitting, but nothing that's constraining its critical path, nothing that's on a critical path currently. So it's not having much of an impact on us at this point.
Okay, that's helpful. And then as another question, it seems like there's some debate about whether Permian gas pipelines, have good returns. You have a slide in your appendix at the last investor day which shows a multiple kind of in line with or even better than your average. But I think some others with proposed projects have said that the mix of returns and duration didn't meet their bar. Can you just clarify that the Permian gas pipe projects that you're working on are kind of in line with your backlog average and that you're comfortable with the duration of the projects and just any other color?
Yeah, no, we're getting these projects under contract at attractive returns with long-term contracts, and so it's they're good double-digit unlevered after-tax returns, and it's not a 15% unlevered after-tax return, but they're good solid returns. And I agree with the observation. Just generally, I mean, we've looked at other opportunities out of the Permian, crude and otherwise, and we haven't been able to find the return levels that we would require to participate in that. But we're satisfied with the returns, and they're inline returns on our gas transportation expansion projects out of the Permian.
And this dovetails with what we said at the beginning of the call, which is we are using a disciplined approach as to how we allocate our capital. So we're not chasing deals that don't make bottom line sense for Kinder Morgan.
That's helpful. Thank you.
I think our next question comes from Robert Catelier with CIBC Capital Markets.
Thank you. I just wanted to ask, what is the impact on operations from the production curtailments in Alberta?
The contracts that we have are take-or-pay. They're MWC-based monthly warehousing charge, so we have not seen an impact.
But you're not. I understand that take-or-pay, you wouldn't see an impact there, but operationally, are you seeing anything? Any different?
We actually at our Alberta crude terminal, we had record volumes in the fourth quarter. We had been averaging 77,000 a day. We had 146 in the fourth quarter, and in December we were up to 168 and hit an all-time one-day high of 265. So volumes had been very strong. Now we have seen them fall off a little bit in January, as you would have expected, but it has had no impact on the bottom line.
Okay, and then if I could get the net interest impact on the Trans Mountain sales proceeds, that impact on the DCF for KML. What I'm trying to extract is the interest income specifically related to the proceeds versus other interest expense you might have.
Yeah, I think you can assume we paid back for the quarter. We didn't have any debt drawn during the quarter for KML.
Asking how much interest income is in DCF.
Yeah, so I think it's the 24.7. It's the full amount there. So I'm saying that full amount, we didn't have any amount borrowed during that piece. So the full amount is the interest from the.
And that's the pre-tax or post-tax amount? 24/7.
That's the pre-tax amount.
Okay. Thank you.
I think our next question comes from Michael Lapidus with Goldman Sachs.
Hey guys, easy question for you. Can you quantify what the impact on volumes being moved towards Mexico was in your system either for the quarter or for the full year?
Impact on volumes moved to Mexico?
Yeah, or volumes directed to Mexico, through your system. I'm just trying to get a gauge of whether your system is seeing a material benefit yet, and if not now, when.
Okay, so we moved 73 million cubic feet a day incremental to Mexico on our system during the fourth quarter versus the fourth quarter of 17.
Got it. Okay, so still relatively small relative in the grand scheme of things.
That's
incremental.
That's incremental.
Understood.
We're in excess of 3 BCF a day on average.
Right.
Right. Okay. Thanks, guys. Much appreciated.
Okay, the next question comes from Chris Signolfi with Jefferies.
Hey, Chris.
Hey, good afternoon, Steve. Thanks a lot for the added color. I guess following on the last question, I just want to ask about export trends you're seeing on the refined product side. There's been a rash of articles recently about, growing gasoline prices in Mexico with efforts, by the government to crack down on pipeline stuff. So curious if at all how that's impacting you and how the teams might be responding.
We had record volumes on the Houston Ship Channel from an export standpoint. We were up almost 8.5% from a volumetric standpoint over our ship docks and 10.1 on total volume. So very, very strong movements on the gasoline and diesel over our docks. In Houston alone, gasoline was up 8% and distillates were up 6%.
Those figures, are those 4Q numbers you're putting, or those full year?
Full year numbers.
Okay. And has that changed at all? I guess we're very early in the new year, but it seems like a lot of this is escalated once the calendar turned. Just curious if the conditions there have altered in any way.
No, the only thing we've seen a little more of is we're seeing more volume move via rail out of our former crude by rail facility, which has now been repurposed to handle gasoline and distillates, and that's starting to ramp up.
And it's destination Mexico.
That's all Mexico.
Okay. Okay, perfect. Thanks a lot, guys. Appreciate it.
Okay, next question comes from Merrick Stack with Citigroup.
Hi, good evening, everyone. Hi, just a quick one from me. In the CO2 segment, the mid-Cush differential that you have hedged mostly for 2019, are those levels fairly similar to kind of what we saw in the fourth quarter?
Yeah, it's roughly $8 a barrel.
Okay, and just one quick follow-up. Regarding the acquisition of the Rennick field, are you looking to potentially do additional acquisitions of this type going forward, or might that depend on sort of how you see tall cotton develop over time?
Yeah, I mean, that was a bit unique, given its relationship to our Sac Rock field, and our ability to use that field for multiple purposes, meaning it produces oil and NGLs, but also the CO2 that it uses could be perhaps better used elsewhere in our portfolio, and perhaps offsetting capital investments that we might make in order to expand CO2 production. So I would call it somewhat unique, but it's an example of the kind of things that we look out for, things that fit and that integrate well with our existing operations.
Okay, great. Thank you very much.
Okay, the next question comes from Becca Followell with U.S. Capital Advisors.
Good afternoon. Hey. Two questions. One, given that you're in settlement discussions on EPNG and pre-settlement on Tennessee, any change to the guidance you'd given for roughly $100 million impact over time and no impact in 18 or no impact in 19?
No change as yet. We're early in those discussions. We're encouraged to be engaged on those two systems, but we don't have any update in our guidance or outlook there. I think the $100 million is still good from our perspective. It reflects the tax-only component of that, and we'll just have to see where the discussions come out. But we prefer this environment. We've traditionally been able to work things out with our customers, and we would rather be doing it here than in a FERC process. So we're happy to be engaged on both of those systems.
Understand. Thank you. And then back to Ruby. Can you remind us of the structure there? I think Pembina has preferred, and so that carves off a big chunk of the EBITDA. So if by chance PG&E were to abrogate or to recut that contract, would that disproportionately hit KMI?
It would disproportionately hit KMI, and you're correct. Pembina's interest is a preferred, and that's why, as I said, it is a material matter to our interest in Ruby. But as I also said, we think that there's reason to be optimistic about these contracts.
Great, thank you.
I think our next question comes from Danilo Giovanni with BMO Capital Markets.
Thank you. A couple of quick follow-up questions for me. Firstly, on KML, are there any major sticking points that may cause a potential slippage beyond the next earnings call?
There's always a potential for that, but I think we feel like we'll be able to give you an update at the next earnings call.
Yeah, I think that's right. That's our estimated time. It takes time, but we feel like we'll have an answer by that point.
Thanks. And as a follow-up to Jean Ann's question on the Permian pipeline returns, the 6 times multiples that you've outlined before, that's over the course of the 10-year contract duration?
Yeah, what that is showing, I think we stated the same way in all of these, right? 6 times second-year EBITDA multiple. And the contracts, the underlying contracts, are for 10 years. And when we make the decision on the project investment, we're careful to look at a variety of terminal value assumptions to make sure that we're satisfied with the returns that we're getting on our capital in a variety of scenarios.
That's it for me. Thank you.
I think our next question comes from Jeremy Thomas with J.P. Morgan.
Hello again.
Hi, sorry. Just a quick little follow-up. I wanted to touch base on Elba here. I was wondering if you could expand a little bit more on the drivers to the delay in going, I think it was like during first quarter, you said before, now end of first quarter. You guys feel comfortable with the timeline, or what's happened there exactly?
Yeah, so the delay continues to be associated with contractor productivity. We're obviously getting into the final days here, and we have people on the ground watching the progress that we're making. We're in commissioning activity simultaneous with the completion of the project, and so we think end of Q1 is a good and reasonable estimate for when we'll be complete. There's obviously a band of uncertainty around that date, but we think we're closing in on it here.
Great, that's helpful. That's it for me. Thanks.
Again, at this time, I'll share no further questions.
Okay, well, thank you all very much for spending time with us, and we will see most of you next week at the Investor Day. Thank you.
Thank you. This concludes today's conference. You may disconnect at this time.